This episode is for property investors. If you've been watching Victoria's market and thinking it's all gotten too hard, too many taxes, too many regulation, too much uncertainty, I want to have an honest conversation with you. Because I think some of the concern is completely justified. And I'm not going to stand here and tell you Victoria is the easiest investment environment at the moment. It isn't. But I also think there is something important that a lot of investors are missing, and I want to show you what I mean. Let me lay out the actual cost environment in Victoria for foreign investors, clearly and without spin. First, the absentee owner surcharge. If you are a foreign person and you own residential land in Victoria, you pay a 4% surcharge on top of standard land tax every year. That was increased and locked in from the 2024 assessment year. It's not going anywhere in the near term. Second, the land tax threshold was dramatically reduced. The tax-free threshold used to be $300,000 in site value. It's now $50,000. That means the vast majority of Melbourne investment properties are now attracting land tax from day one. Third, the Vacant Residential Land Tax. If your property sits vacant for more than 6 months in a year, you are hit with a 1% annual tax on the capital improved value that rises to 2% after 2 years and 3% after 3. This applies statewide now, not just to Melbourne. Fourth, there's a 7.5% short stay levy on short-term rental platforms like Airbnb for stays under 28 days. That's a significant change if you're considering that income strategy. And fifth, Victoria's tenancy laws have become more tenant protective over the past few years, which adds compliance obligations to landlords. That's the honest picture. Holding costs in Victoria for foreign investors are materially higher than Queensland and Western Australia. You need to factor that into your modeling. Now, I want to tell you what I think most people are getting wrong. Because of everything I just described, because investors pull back, because sentiment soured, Melbourne property has done something remarkable. It has become the most affordable it has been relative to other Australian capitals in over a decade. Melbourne's median house price is now similar to Adelaide's. It's lower than Perth's. Let me say that again, Melbourne, one of the world's most livable cities with world-ranked universities, 5 million people, and all the infrastructure of a major global city is now priced similarly to Adelaide and Perth. If you have been investing in property long enough, you know what happens next. This kind of inversion doesn't last, it corrects. And the investors who buy at the bottom of that correction are the ones who look very smart in 5 years' time. And let me give you a historical comparison. Perth had a brutal few years from 2015 to 2020. Falling rents, falling prices, investor fleeing. The headlines were terrible. The people who bought in that window, the ones who were willing to look past the short-term negativity, has since been seen value double or more. Brisbane in 2019-2022 was slow and uninspiring, and people who bought during then has seen prices surging and are considered brilliant investors. Melbourne in 2026 looks a lot like Perth in 2018 and Brisbane in 2019. The smart money knows this, and it's quietly coming back in. Investor lending data in Victoria is already showing an uptick. That's an early signal. Now, this matters a lot. Not all Melbourne property is equal for foreign investors in the current environment. The play that makes the most sense when you factor in tax environment is units, specifically new and off-the-plan units. Here's why. Units have lower land content. That means the site value, the taxable base for land tax is lower. New builds in the early years tend to have lower assessed site values, further reducing your land tax exposure. units are in the highest demand rental category in Melbourne right now, with vacancy rates at 2%. Lower tenanted properties near employment and transport corridors have strong yields. Off-the-plan purchasers still benefit from the stamp duty concession the Victorian government has extended to October 2026. New builds come with builder's warranty, lower risk for absentee owners. The unit market happens to be KPMG's most aggressively forecasted growth at 7% through 2026. One more practical point for investors who are worried about vacant residential land tax. The solution is straightforward. Keep your property tenanted. In Melbourne's current rental market, with vacancy at 2% or lower, keeping a well-located unit tenanted is not difficult. A good property manager handles this entirely. The tax applies only to properties that are genuinely unused for 6 or more months in a year. If you're renting it out, you have no exposure. Let me close with the structural argument. Melbourne's population growth is not a speculation. It's driven by Australia's immigration program, one of the most consistent in the developed world. Melbourne is the destination for tens and thousands of skilled migrants, international students, and families every year. That demand doesn't turn off because a government changes its tax settings. It's structural. The short-term headwinds are real. The long-term fundamentals are unchanged. Before I close, I want to add one more layer to the investment case, and it's one that I think is genuinely underappreciated by overseas investors. The Australian dollar is currently weak by historical standards. For investors from Malaysia and Singapore, that means you are buying an Australian asset at a currency discount, on top of whatever discount the property market is already offering. Here is my honest advice to investors is this: don't let short-term policy settings drive a decision about a long-term asset. Victoria's tax environment is higher than it used to be. Accept that, model it in, and then ask, does the capital growth projection, the rental yield, and Melbourne's structural demand still makes this a compelling investment over the next 7 to 10 years? For the right property, new, well-located, well-priced, the answer, in my view, is yes. And right now, you can buy that at prices that Melbourne's cycle history tells you will not persist for long. If you like to run the actual numbers on a specific property or suburb, reach out to us. That's what we're here for. Thank you for watching.